Dear students, today we are discussing solution of assignment problem 4a. This is problem 4a. So let's start reading it, and I will try to explain these transactions as well so that you can understand these transactions easily. Altas acquires source, adjusts and closes its accounts once a year on December 31st. So the name of the company is Altas Aqua Resort and the closing period is 1 year, not a month. Most guests of the resort pay at the time they check out, and the amounts collected are credited to rental revenue. The revenue earned by that company is called rental revenue, and the customers makes payment to that Alta Sequoia Resort when they leave their hotel. A few guests pay in advance for rooms, and these amounts are credited to unearned rental revenue at the time of the receipt. So there are few guests as well who make payments in advance, but the amount which is collected in advance from the customers is termed as unearned rental revenue, and it is considered as liability until some part of that revenue is earned. The following information is available as a source for preparing adjusting entries at December 31st. Now, these are the entries which are given A, B, C, D, E, F, G, H. Now, before reading these transactions, you should also look at the instructions. For each of the above lettered paragraph, draft a separate adjusting entry including explanation. If the information indicates that an adjusting entry is needed, one or more of the above paragraphs may not require an adjusting entry. Now you have to keep in mind there may be one or more transactions which are need not to be recorded into books of accounts. So when you are preparing adjusting entries journal, first you have to write down name of the company, which is Alta Sequa Resort, and then adjusting entries journal, then the period which is for the year ended December 31st 2000. As year is not given clearly in the problem, so we have written 2000. You can write 2001, 2020, whatsoever. First I will read each transaction, and then we will discuss what are the title of accounts which are involved and what is debited and what is credited. So let's read transaction A. Salaries earned by employees but not yet recorded or paid amount to 7,900. Transaction A is an example of recording unrecorded cost adjusting entry or recording unrecorded expenses adjusting entry. Here, organization has incurred salaries expense of 7,900 but employees are not paid. Company has not made payment of that salaries expense to employees. So even they have not made payment, they have to show that expense into books of accounts. So in this transactions, title of accounts as expenses incurred. So first title of account on debit side will be salaries expense. As salaries are not paid, they will be paid. So it means they will show credit title of account salaries payable. Salaries payable is liability. Increase in liability is recorded on credit. So they will show debit salaries expense 7,900 and credit salaries payable 7,900. Explanation will be to record the salaries expense and related liability to employees by the end of the year. So that's all about transaction A. Now I am reading transaction B. As of December 31st, Alta Sequa has earned 11,075 rental revenue from current guests who will not be billed until they are ready to check out. Debit, rent, receivable. This is transaction B is example of recording unrecorded revenue adjusting entry. Why it is unrecorded revenue adjusting entry? Because company has earned revenue, but amount of that revenue is not collected from the customers. So although amount is not collected, but they have to show that revenue into books of accounts. So if amount is not collected, we will show that revenue receivable from the customers. So here revenue is rent revenue. So what is receivable? Rent is receivable. So first title of account in this transaction will be rent receivable. It will be recorded on debit side because rent receivable is an asset. Increase in assets is recorded by debit. So we will debit 11,075, and another title of account is rental revenue earned. Increase in revenue is recorded by credit. So we will credit rental revenue earned 11,075. That's all about transaction B. Now reading transaction C. On November 1, a suite of rooms was rented to a corporation for 6 months at a monthly rent of 3,200. The entire 6-month rent of 19,200 was collected in advance and credited to unearned rental revenue. At December 31st, 2 months rent is considered to be earned. The remainder is for the first 4 months of the following year. Now, transaction C is example of apportioning unearned revenue adjusting entry. Here company has collected 6-month rent revenue in advance, which is 19,200 on November 1. Now it's December 31st. Now from November 1 to December 31st, 2-month period is passed. So it means company has earned revenue of 2 months out of total unearned revenue. So now 1 month revenue is 3,200. So 2 month revenue will be 6,400. So what are the title of accounts involved here? First, unearned rental revenue is recorded as a liability. So out of that unearned rental revenue of 19,200, 2 months rental revenue of 604 months is earned. So liability of 19,200 unearned rental revenue is decreased by 6,400. So decrease in liability is recorded by debit. Therefore, we will debit unearned rental revenue 6,400, and rental revenue for 2 months earned is 6,400, which is recorded on credit side because increase in revenue is recorded on credit. So credit rental revenue earned 6,400. Explanation will be to record the 2 months rent unearned from the 6-month rent collected in advance earned from a company. So that's all about transaction C. Now reading transaction D. A limousine to carry guests to and from the airport had been rented beginning December 19 from Transport Rental in charge at a daily rate of 120. No rental payment has yet been made. The limousine has been rented for 13 days in December 30. So transaction D is example of recording unrecorded cost adjusting entry. Company has rented a limousine. Limousine is it's a type of automobile. So they have rented that automobile on December 19. Now it's December 31st. So from December 19 to December 31st, it means they have rented limousine for 13 days in the current period. So 13 days rent expense will be 120 multiply 13, it will be 1560. So we have to show that rent expense of limousine 13 days rent expense into books of accounts on December 31st. So first title of account will be rent expense 1560. As rent is an expense, increase in expense is recorded by debit. So rent is yet not paid to company, so we will show that as rent payable liability. So increase in liability is recorded by credit, so we will credit rent payable 1560. 60. So explanation will be to record the 13 days rent expense incurred on limousine and related liability. That's all about transaction D. Now I am reading transaction E. A 6-month loan in the amount of 30,000 has been obtained on December 1. Interest is to be computed at a rate of 15% per year and is payable when the loan is due. No interest has been paid and no interest expense has been recorded. Now, transaction E is example of recording unrecorded costs or unrecorded expenses. Adjusting entry. Now, company has borrowed loan of 30,000 and the interest rate is 15% per year. So, 15% of 30,000 will be 4,500. But they have borrowed debt loan on December 1. Now they are passing adjusting entries on 31st December. It means 1 month interest is incurred. So company is supposed to record that 1 month expense into books of accounts. So 1 year expense is 4,500. So how can we find out 1 month interest? Simply dividing 1 year interest 4,500 divided by 12. So 1 month interest will be 375. Now title of accounts in that transaction ER1 is interest expense incurred and other is as company has not made payment of the interest, so we will show liability interest payable. So debit title of account will be interest expense 375 and credit will be liability interest payable 375. Explanation will be to record the interest expense incurred on notes payable for the month of December. That's all about transaction E. Now I am reading transaction F. Depreciation on the resource building is based upon an estimated useful life of 30 years. The original cost of the building was 1,755,000. Now transaction F is example of apportioning recorded costs. Company has purchased building, cost is 1,755,000 and estimated life is 30 years. So how can we find out depreciation for a year? Simply dividing the cost 1,755,000 divided by the estimated useful life of that fixed asset, which is 30 years. Now the depreciation for 1 year will be 58,500. So depreciation expense is increased. So we will record on debit side depreciation expense building 58,500 and we will credit contra asset account which is called accumulated depreciation on credit side and we will write credit title accumulated depreciation building 58,500. Explanation will be to record the depreciation on building for the current year. That's all about transaction F. Now transaction G. In December, Alta Sequoia Resort entered into an agreement to host the annual symposium of as American for a Clean Environment in April of next year. The resort expects to earn rental revenue of at least 45,000. Now in transaction G you can see that company has not earned revenue, it is expected revenue. So in accounting records we don't uh, write about something which is to be earned in future. This is future revenue, so they have earned nothing. So such type of transaction is not recorded in adjusting entry. So we will leave these transactions. As in beginning I told you one or more transaction may not require to be passed. So this transaction is not required to be passed. Now the last transaction, transaction H. A 1-year fire insurance policy has been purchased on September 1. The premium of 7,200 for the entire life of the policy had been paid on September 1 and recorded as unexpired insurance. Now this is example of adjusting entry apportioning recorded cost. First adjusting entry. Now a company has purchased fire insurance policy for 1 year 7,200. Now what will be the fire insurance policy for 1 month? It will be 7,200 divided by 12, it will be 600. As company has purchased that fire insurance policy on September 1, now they are passing adjusting entries on December 31st. Now from September 1 to December 31st, out of unexpired insurance policy of 7,200, 4-month policy is expired. So 4-month expired policy cost will be 600 multiply 4, it will be 2,400. So unexpired insurance total, and out of total unexpired insurance of 7,200, insurance of 2,400 has been expired in the current accounting period up to December 31st. So we will show that insurance expense into books of accounts. So first title will be insurance expense debit 2,400, and as unexpired insurance is an asset, so decrease, it is decreased. 4-month unexpired insurance is expired, so it is decreased, asset is decreased, so decrease in assets is recorded by credit. So we will credit unexpired insurance 2,400. Explanation will be to record the part of 1 year insurance expired in the last 4 months of current year. So that's all about transaction H. So we have completed all these transactions and recorded into adjusting entries journal at the end of the accounting period. So that's all about this problem 4a. Thank you.